June 30, 2023, the day the world watched in stunned silence as Credit Suisse's stock plummeted more than 40% in a single morning, erasing billions of dollars of market value and sending shockwaves through the global financial system. That historic plunge was not just a market anomaly. It marked the abrupt end of a 167-year legacy of Swiss banking prestige, a saga that began in a modest Zurich office and concluded in a desperate rescue that left the industry reeling. Founded in 1856 by Alfred Escher, Credit Suisse emerged from the vision of a young nation eager to cement its place in international finance. The bank's early years were defined by bold ventures, financing the Trans-Alpine Railway, underwriting the world's first multinational bonds, and pioneering private banking services that attracted aristocrats and industrialists alike. By the turn of the 20th century, Credit Suisse had become synonymous with Swiss stability, its deep vaults and discreet client relationships epitomizing the country's famed secrecy laws. The post-World War Roman II era propelled the bank into a new dimension of growth. Leveraging Switzerland's neutral status, Credit Suisse expanded into wealth management, offering expatriates and royalty a safe haven for their assets. The 1980s and 1990 saw an aggressive diversification strategy, mergers with First Boston, a foray into investment banking, and a rapid increase in global footprints across Europe, the Americas, and Asia. By 2008, the bank boasted assets exceeding $1 trillion, a workforce of over 50,000, and a reputation that could weather even the fiercest market storms. Yet beneath the polished facade, warning signs began to surface. The first cracks appeared in the early 2000s, when the bank's aggressive pursuit of high-yield, high-risk products started to outpace its risk management capabilities. The 2008 financial crisis exposed vulnerabilities. Credit Suisse suffered a Euros 2 billion loss on its exposure to the U.S. subprime market, prompting a costly bailout from the Swiss government and a series of leadership changes. Though the bank recovered, the incident left a lingering imprint on its culture, fostering a sense of overconfidence that would later prove fatal. In 2015, a series of compliance failures revealed a darker underbelly. Credit Suisse was fined Euros 2.5 billion by US and UK regulators for aiding clients in evading taxes, a scandal that tarnished its reputation for secrecy and discretion. The bank's internal whistleblowers warned of inadequate anti-money laundering controls, yet senior executives dismissed these concerns, prioritizing revenue growth over regulatory adherence. By 2018, the Greensill and Varchigos debacles had already begun to test the institution's resilience. In the Greensill collapse, Credit Suisse's $10 billion supply chain finance fund was left exposed to a single client's default, leading to a massive write-down. A year later, the Archegos family office's meteoric downfall forced the bank to absorb staggering losses of $5.5 billion in a single quarter, eroding investor confidence and prompting a cascade of executive resignations. The final act unfolded with the arrival of a new CEO, Ulrich Körner, in early 2022, who pledged a new era of risk discipline and cultural reform. However, the momentum was insufficient to reverse the tide. In early 2023, rumors of mounting credit defaults and a deteriorating balance sheet spread through the corridors of Wall Street. Credit Suisse's share price, once a stable anchor in the market, began a relentless descent. On March 10, the bank announced a Euros 5 billion loss for the previous year, citing a significant increase in credit risk. The announcement ignited panic among investors, and the following weeks saw a flood of deposit withdrawals, a steep rise in funding costs, and a sharp downgrade by rating agencies. The tipping point arrived on March 19, when the Swiss National Bank disclosed that it would provide a temporary liquidity bridge to stave off a systemic crisis. Yet the bridge was a band-aid, not a cure. By the end of March, Credit Suisse's capital ratios had slipped below regulatory thresholds, prompting the Swiss government to negotiate an emergency rescue. In a dramatic televised press conference on March 22, Swiss Finance Minister Karin Keller-Sutter announced that the nation's central bank and the Federal Department of Finance would facilitate a takeover by UBS, the country's largest rival, in a deal valued at $3.2 billion. The merger, completed in a whirlwind 48 hours, marked the end of Credit Suisse as an independent entity. The aftermath rippled far beyond the Swiss Alps. International markets experienced a sudden spike in volatility as investors questioned the robustness of other too-big-to-fail banks. The collapse sparked a renewed debate over the efficacy of global banking regulations, prompting the Basel Committee to propose stricter stress testing and liquidity requirements. In Switzerland, the scandal triggered a parliamentary inquiry into banking secrecy, leading to a gradual erosion of the country's traditional privacy shields and a pivot toward greater transparency. For the thousands of Credit Suisse employees, the merger meant a wave of redundancies, cultural clashes, and an uncertain future under UBS's corporate umbrella. Clients faced a complex transition, with some wealth management portfolios restructured and others dissolved entirely. Meanwhile, shareholders, both institutional and retail, saw their investments wiped out, prompting lawsuits that would linger for years. The bank's once proud legacy of discretion and stability now serves as a cautionary tale about the perils of unchecked ambition, inadequate oversight, and the relentless pressure to deliver short-term profits in an increasingly interconnected financial world. As the dust settles, the story of Credit Suisse stands as a stark reminder that even the most venerable institutions are not immune to collapse when risk is ignored and culture erodes. Subscribe to The Collapse for more stories like this.